right, recorder is on. So let's talk about Amazon. We're going to talk about what I just talked about. No, Kent, it's not back on. The last signal in Tesla is to cancel the original signal. It was never back on. If I look in the signal tab, are you talking about the announcement tab? Kent, the last thing I see at the very top there is cancel Tesla. So no, there is no current Tesla signal. All right. So Amazon. First, let's talk about what I talked about on TV this morning, and then we can talk about what we may do here. Okay, so I'm going to bring in this chart. Okay, and I talked about Bob, I can have someone at help desk call you if you'd like. All right, so I talked about how 1685 was a downside number that I personally, if the stock got down there, would like to buy Amazon as an investment. Why 1685? Well, basically this right here. Okay, this is back in June. This is back just a few weeks ago. And there's also massive amount of volume. So below the market right here, from where we are right now, that's really the next or first support level that I see in this stock. So for me, long term, as an investor, not as a trader, but as an investor, if the stock got down to 1685, I'd want to buy some. Okay, so how do I take advantage of that using options? Well, what I talked about, yep, I could absolutely sell puts, Avi. Yep, sell puts, collect a credit, and if those puts go against me, I'm okay with that, right? Because I want to buy the stock anyway. Exactly, Alan. Alan, sell puts to reduce my basis. So if I look at those 1685 puts, those things are trading right around $5. Actually, they were, I think the stock was about $10 lower when I was on TV, but that's okay. Right about $5. Nice job, David. Okay. So if I sell that put for $5, one of two things happens. And let me get a whiteboard going here. Let me just catch up some notes on the whiteboard here. Okay, for 0. Okay, so that was what I talked about. Again, the key to this is the rationale that I would want to buy stock down at 1685. Okay, so if I do something like this, which is called, there actually is a name for this strategy. Anybody happen to know what the name is? It's not something that we talk about often at all, but does anybody happen to know what the name is? No, it's not a naked put, Ellis, because we're also buying a call. There is a naked put as part of this. It's kind of like synthetic stock, Corey, but synthetic stock would be selling a put, buying a call at the same strike. Robert, yeah, the Scott Iron Bird. No, this is called a risk reversal. That's just the option strategy to it. It's called a risk reversal when you sell a put, buy a call. Okay, and in this instance, I'm able to do this for zero. I'm not collecting money. It doesn't cost me anything to do this. It's a net zero transaction. So when you think about it, what are the ramifications of this position? Well, one, if stock stays between 1685 and 1870, then nothing, right? It's a nothing. Nothing happened. Nothing happened. Ellis, there definitely would be some margin because essentially the brokerage firm is going to look at this as if you would have naked long stock. But it wouldn't be any different than the margin you'd have to put up of buying, let's say, 100 shares at 1685. Okay. Okay, so if the stock stays in the middle there, nothing happens. Right? Both options go out worthless. I haven't collected money. I haven't paid money. It's a net 0, 0, 0. Okay, 2, if stock goes below 1685, I will get assigned the stock at 1685. Again, the key, this is actually this week expiration, but it really doesn't matter, David. We're saying this in general, but this was this week's expiration where I could do this for zero. Okay, so if the stock goes below 1685, I would get assigned the stock at 1685, which, again, is the key here. I want to buy stock at 1685. So I'm not afraid of being assigned. Okay, it's not riskless. I certainly have the downside that I could lose on, right, if the stock gets hammered. But I'm willing to take that because I want to buy stock there. Okay, 3, if stock goes above 1870, I now have a free call. Well, Tom, that could be a margin requirement, right? If I wanted to buy 100 shares at 1685, yeah, that's what I have to come up with. Okay, so this is what I talked about. This is the rationale behind that. And again, obviously, this is not something I would put out for our class here, that type of signal, because we would not want to have that sort of unlimited risk to the downside. That is your risk, right? If Amazon went to zero, you could lose $168,000. Now, if Amazon goes to zero, we got much bigger problems. But that is the risk to this position. Okay, everybody clear with that? I wanted to start the Amazon conversation with just what I talked about on TV just now. Okay, now let's get into our dissection, what we would normally do. Let's go back to the charts here. Okay, Amazon has really struggled. There's been a lot of, like I talked about, a lot of hesitation with this stock. A lot of hesitation. For the first time that I can remember in a long time. part of that may be that you did get this big bearish crossover right here, which we talked about, where the 50-day dropped below the 200-day. That's known as the death cross. There's certainly lots of question about how their AWS is going to perform, if those margins are going to be there. Okay. So, I look at this and say just on earnings. As an earnings trade, I think it's up in the air. There's no distinct pattern here. No distinct pattern at all. My natural bias in Amazon, again, would be to the upside. But there's really no distinct pattern, technically. Does anybody see something that maybe I'm missing? And Bob, if you're still there, I bet you can hear me now, right? Because I just got note from our help desk that you are all fixed. Okay, good. Okay. So again, I look at this here, and sure, we could make a bet, calculated guess on direction. I'd rather go into this saying, I want more of the range-bound trade if we can get paid appropriately for it. If we can get paid appropriately. Okay, so what is the expected move in Amazon? Stock's sitting right at 1775. Tom, why do you say down? Expected move doesn't measure direction. Expected move measures the magnitude of the move, not direction up or down. I mean, you may think it's going down, and that's fine, but that is not what the expected move measures. Does that make sense to you? I don't want you to just say, okay. Does that make sense? I mean, you may have a bias, okay, that it's going down. Okay. So the expected move somewhere right around, $65, $67, somewhere in that range. I actually see it now with Vol. Vol is ticking up a little bit right now, so almost, like Deborah said, almost closer to 70. Okay, so let's put this up here. Stock is 1775, and we'll call the expected move $68. So that gives me an expected range of 1707 all the way up to 1843. Okay, if we go back to the chart here, we're not going to see really much around 1707. However, there's that area we talked about, kind of 1685 to 95 area where there's support. Resistance-wise, there's probably some resistance right here at this big volume area around 1830. Then maybe again up here around 1850. So somewhere in that range right there. Russell, Whirlpool from the other day? Yes, and we haven't exited it yet. Okay. So, given that expected range, 1707, 1843, let's look at a iron condor here. Okay, here's a $10 wide iron condor. This is the 1710, 1700, and the 1835, 1845 iron condor, which is trading about $4.60. Gives us break-evens of 1705.40 up to 1839.60. Okay, break-evens on both sides are slightly inside. Actually, on the downside, on the downside, that break-even is fine. On the upside, it's a little tight. However, the $4.60 gives us what sort of reward to risk? Only 0.85. This is this week, Bill. Only 0.85 to 1. Okay, yeah, it's a little tight. I'd probably want to do this for about 475. So, we can certainly look at other strikes, meaning a $5 wide, a $7.50 wide. I just picked the $10 wide one just to really start with, just to, get a gauge here. And if we look at similar ones, I now change this to a $7.50 wide iron condor here. And I could put up here that the 1710, 1702.5, and 1837.5, 1845 iron condor is trading $3.40. That gives us break-evens then of 1706.60 up to 1840.90. Okay, that gives us better break-evens compared to the expected move than the $10 one. And what is the reward to risk here? It's a little bit worse. So our John, I have it as 0.83. Remember, this is a $7.50, not a $7. Okay, so better area for risk in terms of the expected move, getting paid a little less for it. Okay, so what this just kind of tells me from this very small sample size is to get to our reward to risk that we look for, we need to see vol tick up a little bit more. Okay, now, if we want to pick a direction, up or down, we can certainly do that and go right ahead and probably find a call spread, a calendar spread, a butterfly, a broken wing butterfly, something that makes a lot of sense. But to me, that really wouldn't be prudent. Now, if any of you have an inkling, say, hey, Scott, what would be a decent upside play? What would be a decent downside play? Be happy to go through that. Again, I personally think, as an investment, you have to buy Amazon. As a trade, which is what we're doing here, it's to me a flip of the coin right now. I think you got to buy it on any weakness, though. If it sells off, I think you do have to buy it. So if this thing does sell off, I'd be looking to buy it tomorrow. Okay, any questions here? What type of spread, Tom? Are you saying to sell a put spread? For this week, next, what would you like to look at? I mean, I like that too. Again, from a longer term perspective, I like that too. Now, you're not going to get a ton of premium. Even if you sold, let's say, the 1680, 1675 put spread, it's 50 cents. At that point, it's not even worth it. It's not even worth it. To me, anyway. Yeah. All right. Let me get this video posted up. I'm still going to keep looking here, see if there's something else creative we can find in Amazon, because it's obviously very liquid. And we will go from there. Okay, thank you for your time, everybody. And again, if there's something you want to look at, and in fact, that goes, Julie, I'm going to call you out here, if you don't mind. Julie just sent me an email and said, hey, Scott, can you take a look at this? Happy to do it. Happy to do it. That's what I'm here for. Okay. All right. I'll be right back, guys.